Welcome to the video. Today we critically examine permanent life insurance, especially whole life, and why, for most people, it underdelivers as an investment. We will contrast the math behind cash value with basic market returns, discuss when insurance is actually needed, and map out actionable steps if you choose to pivot. We will move smoothly from high-level concepts to practical decision workflows, and we will include a clear disclaimer so you can apply this responsibly. Next, let's preview our agenda. Here's the roadmap. First, we'll establish the central problem. Next, we'll quantify the math behind cash value growth versus market investing. Then, we'll ask the crucial question of whether you even need life insurance. After that, we'll give precise action steps. We'll also compare whole life and term life side by side, walk through visual diagrams, and test your understanding with a couple of quick quizzes. Finally, we'll wrap with key takeaways and immediate next steps. Now let's start with a brief but important disclaimer. This content is educational and not individualized financial, tax, or legal advice. Your situation may differ materially based on health, age, policy features, tax basis, state regulations, surrender charges, and your goals. Cashing out a policy can trigger taxes on gains, and loans can reduce death benefit and cause unexpected lapses. Consider a 1035 exchange if appropriate, and always confirm new coverage is in force before surrendering an existing policy. Policy illustrations are not guarantees. With that in mind, let's now move to the big idea driving today's analysis. At a high level, whole life is a hybrid. You get a death benefit and a cash value component. However, the embedded commissions, ongoing policy fees, and cost of insurance charges often suppress growth for many years. Liquidity can be limited, and loans or withdrawals can have complex consequences. Meanwhile, relatively simple alternatives, term life for protection, and low-cost index funds for growth, often outperform over long horizons. Next, let's put numbers around this with the harsh math of cash value. Let's quantify the problem. Consider an example of paying roughly $200 per month for about 20 years. That totals around $48,000 to $52,800 in premiums. In many real-world cases, the cash value after 2 decades sits near the amount contributed, which implies minimal actual growth after accounting for costs. Meanwhile, if that same $200 per month had been invested consistently into diversified, low-fee index funds, historical returns suggest the ending value could be 2 to 3 times higher than the cash value within a whole life policy. The primary reasons for this underperformance are high commissions, ongoing internal costs, and cost of insurance charges within the policy. Furthermore, liquidity in whole life is not straightforward. Access often requires loans or withdrawals that can reduce the death benefit and may introduce interest or tax implications. With the math framed, we now turn to the most important decision question. This simple comparison frames the opportunity cost. In many cases, whole life's cash value after about 20 years sits near the total contributions, while diversified index funds, assuming historical long-run returns, can produce outcomes in the range of roughly 2 to 3 times the cash value. These figures are illustrative and not guaranteed. Actual results vary. However, the directional takeaway is that high internal costs and commissions often suppress performance inside whole life relative to low-cost market investing. Next, let's convert this understanding into a decision flow. This flowchart begins with the core question. Do you actually need life insurance coverage today? If yes, prioritize affordable term life that matches your coverage duration and invest the premium difference for growth. If no, evaluate surrender or a 1035 exchange to move value into a more efficient vehicle, then redirect premiums to low-cost investments. The flow also highlights safeguards. Never surrender before new coverage is in force. Check taxes and surrender charges with a professional, and consider whether a 1035 exchange can mitigate tax impact. Now that the decision logic is clear, let's outline concrete steps to execute. Here's a practical sequence. First, confirm whether coverage is required based on dependents, income replacement, and outstanding obligations. If coverage is needed, apply for a term policy and wait until it is fully in force before touching the existing policy. Next, obtain an in-force illustration to see surrender charges, current cash value, cost basis, and any policy loans. Consult a tax professional about potential taxable gains and whether a 1035 exchange could be beneficial. If the analysis supports it, Surrender the policy or execute the exchange to stop compounding sunk costs. Immediately redirect the monthly premium savings into low-cost, diversified index funds, and ensure you have a separate emergency fund for liquidity. Finally, review your coverage and investments annually to stay aligned with changing needs. With steps in hand, let's compare whole life and term side by side. On the left, whole life features high, lifelong premiums and a cash value that often grows slowly due to internal costs. Accessing funds may require loans or withdrawals that reduce benefits and add complexity. It can fit specialized scenarios such as estate planning, but it is frequently unsuitable as a primary investment vehicle. On the right, term life offers low premiums for a set duration with no cash value, making it cost-effective coverage for income replacement while you invest separately in higher growth vehicles. Next, test your understanding with a quick question. Question: what is the single most important question to answer before deciding to keep or surrender a permanent policy? Options: A. What dividend rate did the agent illustrate? B. Do you need life insurance coverage right now? C. How much has the S&P 500 returned in the last 5 years? D. What surrender fee applies this month only? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Determine if you actually need life insurance coverage right now. If you do, secure term coverage and then consider what to do with the existing policy. If not, evaluate surrender or a 1035 exchange and redirect the freed up cash flow to efficient investments. Now, let's unpack the cost layers that often erode whole life returns. Whole life performance is often hampered by multiple cost layers. Sales commissions take a significant early cut, which is why cash value typically builds slowly in the initial years. Mortality and expense charges continue to extract value annually, and administrative fees, though they may look small, compound into meaningful drags over time. Surrender charges reduce flexibility and can penalize early exits. Policy loans are not free. Interest and netting can impact both the cash value and the death benefit. Finally, dividends are not guaranteed. Projections based on optimistic assumptions can lead to disappointment when actual results underperform. Now, to visualize the drag, we'll look at a fee breakdown pie chart. This pie chart illustrates how different cost components can add up to a substantial drag on growth. Significant commissions, ongoing mortality and expense charges, administrative fees, surrender-related impacts, and other costs. While exact percentages vary by policy, the aggregate effect is a strong headwind against compounding. Next, let's take our second quick quiz to reinforce the operational steps. Question: before surrendering a permanent policy, which action is most prudent? Options: A. Cancel immediately to avoid more fees. B. Borrow the max and invest it aggressively. C. Get replacement term coverage approved and review taxes or 1035 options. D. Ignore the tax basis. It rarely matters. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Make sure any needed replacement term coverage is approved and in force before surrendering the existing policy, and review potential taxes and 1035 exchange options with a professional. This approach prevents coverage gaps and can significantly improve after-tax outcomes. Next, we'll place the journey on a simple timeline to clarify the sequence over years. This timeline shows a typical arc. Early years often see slow cash value growth due to high initial costs. Mid-period growth may improve but typically remains constrained versus market alternatives. Around the 20-year mark, a reassessment is smart. If you still need coverage, transitioning to term while investing the difference can boost efficiency. If you no longer need coverage, you can evaluate surrender or a 1035 exchange. Beyond that, channeling premiums into low-cost diversified funds and conducting annual reviews helps align your plan with evolving needs. To consolidate what we've covered, let's summarize key points. These are the core ideas to retain. First, whole life often lags market alternatives due to internal costs and commissions. Second, the pivotal question is whether you currently need life insurance. Third, separate insurance from investing by using term for protection and low-fee index funds for growth. Fourth, never surrender a policy before replacement coverage is in force if you still need protection. Fifth, evaluate taxes, cost basis, and the possibility of a 1035 exchange. Finally, maintain liquidity via an external emergency fund. Now, let's wrap up with a concise summary and your next moves. To conclude, for many consumers, whole life functions more as a lucrative product for sellers than as an efficient investment for buyers. Redirecting premiums to low-fee diversified investments typically improves long-run outcomes. When protection is needed, term life usually delivers the most coverage per dollar. Execute with discipline. Confirm whether you need insurance. Secure replacement coverage if needed. Analyze taxes and potential 1035 exchanges, and then redirect cash value and premiums toward a more efficient plan. Finally, here's how you can support the channel and continue the conversation. Thank you for watching. If this helped you, please like the video, share it with someone who's considering whole life, and subscribe for more clear, unbiased financial breakdowns. Drop your questions and experiences in the comments. What did your policy illustration promise versus what you've actually seen? Your insights help the community learn. See you in the next video.